Huge news out of China causing Chinese tech stocks to jump 20%, 30%, even more in some cases. What is the news and why could it continue to drive Chinese stocks higher? We'll talk about this and more. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice. And at the time of this video publication, I did own stock in a few of the securities mentioned. So first, KWEB, which is, KWEB is an ETF of Chinese internet securities, down something like 70% in the last year. It has been a bloodbath, yet today alone jumping around 30%, but as you can see, it still has a lot of ground to cover just given what a bloodbath it's been. I recently did a video calling out this Chinese liquidation, and arguably, look, it has been a liquidation where not only has it sold off, you look at KWEB down 70% over the last year, the reality is it accelerated in just the last few weeks where some stocks were down like 30, 40, 50% in the matter of 2-3 weeks. And this was because I'd argue an acceleratingly worse economic picture that you were seeing out of China. You saw lockdowns in China in response to COVID. You're seeing property crisis concerns. Keep in mind, I talk about this in greater detail in that video. You're seeing delisting fears, which I think, in all honesty, are a big nothing burger. It might cause short-term price pressure, but from a long-term investment perspective, I'm focused on the fundamentals, so I'm sort of ambivalent about it. If anything, it could create an opportunity. And also potential hedge fund liquidations. There's a lot of margin debt still in the system, so it's very possible you have some hedge funds just blowing up. And I called that out in that previous video on China liquidations. But I also said, yes, there is this hair and there is this concern. But what I would want to see in order for me to say, hey, now I should be buying even more. And keep in mind, I did buy a little bit more. I did call this out to my Unrivaled Nation, the Unrivaled Journey and Unrivaled Investing Journey subscribers. I did call out, hey, I did buy a little bit of this and that, as these companies were selling off. But what I really want to see before I get even more confident, in terms of buying these things, because look, it's always good to have a healthy, dose of skepticism. But, what would help me out personally with increasing my allocation to some of these Chinese tech stocks is I want to see effectively the government green light. I want to see support from the People's Bank of China saying, hey, we are lowering interest rates. We recognize there's a problem, acknowledging there's a problem. And that's largely what today's news is about, acknowledging a problem, saying we're going to do what it takes to solve the problem. And so you see this, lowering interest rates, potential, quantitative easing of some sort, government intervention. And that's what I want to see, sort of say, oh, okay, the tide is going to turn before I consider making a bigger picture. So today is a very big step, and we're going to talk about what exactly was the news. So you are looking at Chinese stocks jumping the most since 2008. Alibaba, a huge Chinese company, up 25%. Tencent, another huge Chinese tech platform, up 25%. And so the news from China today, from Xinhua, is that the State Council Committee stresses economic and financial stability. Now, Xinhua News Agency is the official state press agency of the People's Republic of China. So this is sort of a mouthpiece that you go, oh, okay, this is important to listen to. So they call out about how the Financial Stability and Development Committee under China's State Council held a meeting on Wednesday urging measures to keep the country's major economic indicators within an appropriate range and maintain stable operation of the capital markets. Okay, this is really important. And with all sort of press releases like this, you have to read between the lines to see what they're saying. When you're saying, yes, we need to maintain, appropriate, economic policies or the major economic indicators, they're saying things have gone off track. They have missed the mark recently, and talking about how they need to deal with this. That's effectively saying there's a problem without saying there's a problem, without saying, oh, there's a fire, like we got to deal with it. They're saying, okay, we got to make sure economic policies are correct. This is their way of starting to acknowledge that there's a problem and that they need to do something to address it. Concrete actions must be taken to bolster the economy in the first quarter. Now, keep in mind, the first quarter ends March 31st. So they're saying now. The meeting said, noting that monetary policy should take the initiative to cope with the situation, i.e. potentially lower interest rates, potential quantitative easing, while new loans should maintain an appropriate growth. This is effectively saying, look, we need to step up with the credit creation to support the economy because it's starting to go off the rails a bit. On the regulation over U.S.-listed Chinese firms, the meeting said the Chinese and the U.S. regulatory bodies have maintained good communication and made positive progress. The two sides are working on a concrete cooperation plan. Honestly, this is the sort of noise around a delisting. If a delisting happens, it's possible. It depends on whether or not the U.S. and China can sort of meet eye to eye on auditing standards. I personally view it as I'm not that concerned if they get delisted because I own, some of the Hong Kong shares, and you can do that through Interactive Brokers. I've called that out before. Where, if it causes short-term price pressure because there's forced sellers because some brokerages can't hold Hong Kong shares, that's like, okay, that stinks for the person that becomes a forced seller that doesn't want to. But, if you're able to hold these things long-term and you're focused on the fundamentals, then great. I'm focused on the fundamentals. So short-term price pressure, honestly, the short-term price pressure of the last few weeks, honestly hasn't even bothered me that much. I mean, this is part of the journey of long-term investing. You judge the companies based on their execution. And some companies are actually still doing really well, growing 20, 30%, executing, doing really long-term investments that strike me as very prudent. And that's arguably what you want to see with investing. You want to see price go down because of short-term fears while companies making prudent long-term investments and still growing. And so, looking at this, whether or not they ultimately are able to see eye to eye, we'll see. The government will continue to support various enterprises to seek listings in the overseas markets. The meeting said. Now, this gets to the point that like every other week, people like to comment like, oh, the VIE structure, variable interest entity structure, like it doesn't make any sense. The Cayman Islands, one day the CCP is just going to blow it up and you're going to be stuck holding the bag, worthless. And like the reality is, the CCP is time and time again have not indicated that that's what they're going to do. If anything, they're like, look, we continue to support listing overseas markets. And that's partly because they want to be central stage and they recognize you have to treat the capital markets well with some respect if you want to be the top dog or if you want to be a top player. So I think this is an acknowledgement that the VIE structure continues to hold. They talk about for real estate enterprise. Now, this is where the crisis is brewing. It is necessary to timely study and suggest effective risk prevention and mitigation solutions and put forward supporting measures for the transformation to a new development approach, said the meeting. This is acknowledging that there's a problem here and that they got to figure out a way to fix it. And keep in mind, nothing here is providing real tangible solutions. It's more like saying, hey, we know we have a problem. We know things have gone off track. We're going to fix it. This is a fix it Felix moment. We're going to fix it. We're not sure how we're going to do it, but we're going to fix it. And so they continue. As for the platform economy, keep in mind, this is major tech platforms, Alibaba, Tencent, others. Relevant departments should improve the established plans to govern the sector. They should steadily advance and complete the rectification work on large platform companies as soon as possible through standard, transparent, predictable regulation, the meeting said. Okay, so what does this mean? This is effectively saying, look, we need to wrap it up. The economy's starting to take a hit. It's starting to go off the rails. Let's make sure, like, we've had a year or two now to say, hey, we're going to set new regulations. We're going to make sure the anti-monopoly policies are put in place. Let's make sure everything's very clear for everyone. Create good standards, and let's move on because this is actually starting to hurt the economy. And some of these are the best of breed companies that help drive the economy. We need to make sure that they're running functionally. And that's part of the reason why these companies are starting to get some respect in capital markets today, up 20, 30%. The meeting stressed that relevant authorities should earnestly shoulder their responsibilities, i.e. this is, financial, actively introduce market-friendly policies and prudently introduce policies with a contractionary effect. Okay, so this is a way of saying, look, when things are booming, you should have contractionary, policies, but, otherwise you should consider market-friendly policies. They're never going to say, purely capitalist policies, but they're going to consider market-friendly policies. Capitalism with Chinese characteristics is what they've described. And authorities should timely respond to issues that draw attention from the market, the meeting said. This is a key way of saying, look, if major Chinese stocks are dropping, 30, 40, 50% in a few weeks, we need to respond to it. We need to make sure that we have appropriate authorities in place that say, oh, okay, there's a problem here. We need to loosen our monetary policy. We need to consider maybe some fiscal stimulus. So you look at all these different things, and I'd argue this is very friendly to the Chinese companies. And that's partly the reason why you're seeing these companies rally. It's sort of saying, let's move on from the regulation. We've set that. Let's make sure the policies are set. Let's make sure they're clear. Let's move on, and let's make sure we get the economy back on track. Let's make sure investors around the world know that they can expect us to respect the VIE structure. They continue. The financial institutions should bear in mind the overall situation. Once again, this suggests there's a problem, and firmly support the development of the real economy. Okay, so let's make sure the economy keeps growing, the meeting said. It added that long-term institutional investors are welcome to increase their shareholdings, i.e., look, you can invest in China. That's what they're effectively saying. We are not going to blow you up. That's what they're saying. Now, could they in the future? Absolutely. Maybe I'm wrong. Maybe I'm reading this all wrong. But I'm looking at this as a quite a bullish development, and I think the capital markets are saying the same thing. Now, look, does this mean all risk is off the table with Chinese equities? Of course not. There are still real concerns. For example, you do have the crisis going on, this Russian invasion into Ukraine. Is it possible, China missteps and, cozies up to Russia, resulting in an even greater global problem, resulting in, let's say, the Western sanctioning of China? It's possible you could see something like that. And that would certainly make the situation a lot worse. So hopefully, both parties, China in particular, plays this, intelligently. Now, I look at the news today, and let's be very clear. The capital markets rallying 20 to 30%. This saying this is a good sign, and I'm pretty much I'm in agreement. I'm saying that here it is. Effectively, the Chinese Communist Party is saying green light. We're going to lock in regulation. We're not going to go crazy going forward. We need to make sure the economy gets back on track, and we need to make sure the regulators, the People's Bank of China, the central government, steps in and supports the economy as well. Right now, first quarter. So this needs to happen now. And so that's how I'm looking at this. I think clearly with the stocks rallying, it is saying this is supportive. But the key aspect here is that there weren't a lot of attention to details in the news release. There wasn't saying, oh, this is exactly what they're going to do. You're going to lower interest rates by 1% or something like that. And that's giving me a little bit of pause, and that's the reason why this is a very good development, but not the one I really want to see. For example, during the great financial crisis, you had this view that if you've got a bazooka and people know you've got it, you may not have to take it out. And that's what Treasury Secretary Hank Paulson told a congressional panel in July, about his plans during the great financial crisis. And this, once again, that didn't work. You can't just say, oh, I have a bazooka, I might use it. And that's sort of what you're seeing here with this Chinese press release. We have a bazooka. We're ready to act if we need to. We can support the economy. The People's Bank of China, the authorities should know that they should support the economy by the first quarter. So you're seeing all these data points. But we have a bazooka, effectively. But the reality is, when there's a crisis and you have credit contracting, like you're seeing with the property development sector, you need to have a response, a capital response that creates credit, offsetting the credit contraction. And that's what ultimately happened in the great financial crisis. You had this immense all-in moment. We haven't seen that all-in moment yet in China. And so while these equities have rallied significantly today, in the last few hours, up 20, 30%, my view is that I personally am waiting to see that all-in moment where you see effectively say, yes, there are these challenges, and we're going to do whatever it takes to support our economy and by proxy these companies, and make sure that both keep growing. And so that's the moment I'm still waiting for. And the all-in moment isn't just saying something. It's you're going to see, oh, okay, quantitative easing or lowering interest rates by a significant degree. It'll be fairly obvious, and you'll see continued volatility. Like, my view is this is seeing plus 20%, plus 30%. You're going to see crazy volatility. I mean, just in the last few weeks, they were down like 50%. So continued volatility. Watch these things. I personally own stakes in them just because I thought the valuations, are compelling. Now they have come underwater, and I have lost some money on them. But I look at a lot of these, positions, and they're still growing, quite well. They're still lucrative, profitable with nice free cash flow, and at valuations like well below what you can get around the world. Now, is it without risk? Of course there's risks in it. I talked about the geopolitical tensions as well as the very real problems that China has to deal with. So you do need to consider all these things. By no means am I saying, hey, you need to go out and buy Chinese equities. That is not what I'm suggesting. Everyone has to figure out what's right on their own journey. I think it's a very complex picture, but I like to see this initial data point effectively from the CCP saying, hey, we need to get on board with supporting the economy, potentially with monetary policies, potentially fiscal policies, and by proxy, that could help a lot of these companies, deal with arguably several of the different fires or crises that might be developing in China. If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.